You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. I'm Susie, he's Miro, and today we are looking at Onsemi, specifically their fourth quarter of 2025. It is February 9th, 2026, and frankly, I think my coffee is the only thing keeping up with this volatility today. Miro, we just saw the numbers drop. It feels messy, but oddly disciplined, like a very tidy car crash.
That is a surprisingly accurate description. Yeah, look, headline numbers. Revenue came in at $1530.1 million. That is down 1.3% from the third quarter. So the top line is shrinking. But, and here's the trick, non-GAAP gross margin actually ticked up to 38.2%, and EPS nudged up to 64 cents a share from 63 cents last quarter. So they sold less, but kept more of every dollar.
Which is sort of the holy grail in a downturn, isn't it? Usually when volume drops, your fixed costs eat you alive, but they're defying gravity on the margins. Are they using magic or just really aggressive accountants?
Well, in this case, the magic is called FabRite. They are running their factories at just 68% utilization. Susie, that is incredibly low. Normally, 68% utilization torches your profit margins because those empty factories still cost money to run, but they managed to expand margins anyway. That tells you they have cut structural costs so deep that they can make money even when the machines are off a third of the time.
Right. It's like remodeling your house to be smaller so your heating bill goes down, which is smart, but it also means your house is smaller.
Exactly. That is exactly it.
But before we go deeper, we should talk about the stock, because the market clearly had a panic attack at the closing bell. Just a quick reminder before I forget, everything we say here is just our personal opinion, definitely not financial advice. Don't sue us. We're just chatting. But yeah, Miro, that after-hours move?
Brutal. So, regular session, it closed around 65.10. Pretty calm. Then the print hits. Boom! Vertical drop to 60. Everyone sees the revenue dip. Everyone sees the guidance, and they bail. But then the call starts. Management starts talking, and it climbs back up to around 63. It's the classic shoot first, ask questions later, algo trading.
It's the V-shape. We saw it all quarter, actually. It feels like investors are on edge, waiting for a disaster that doesn't quite happen. And speaking of things not happening, the industrial segment. For 8 quarters, it's been red, just bleeding. And now?
Green. Finally! Industrial revenue grew 6% year over year. Susie, that is the first growth sign in that segment in 2 years. They are calling the bottom. And unlike previous quarters where it was just hope, the intelligent sensing group, that's the cameras and sensors, that segment actually jumped 9% quarter over quarter. So real hardware is moving.
That's huge, because everyone is obsessing over AI, and we will get to their $250 million AI number in a minute. But Onsemi is really the bellwether for the boring stuff. Factories, cars, energy grids. If they say industrial is bottoming, that's a signal for the whole economy, not just chips.
It is. But don't get too comfortable. Auto revenue was flat. Basically zero growth there. So one engine is starting up, but the other one is still idling.
Okay, idling is polite. I'd say stalled. But look, they've got this story where they're trading revenue for profitability, exiting the non-core stuff. It sounds great on a slide deck, but I want to know if it actually works when you look under the hood, because you can't shrink your way to greatness forever, right?
You definitely can't. Eventually, you run out of things to cut. And there is something in the cash flow statement that, let's just say, it complicates the narrative.
Oh, I hear the skepticism loading up in your voice. All right, let's pop the hood. What did you find?
Well, it's the definition of efficiency that complicates things. Look at the utilization rate again. 68%. Susie, in semiconductor manufacturing, 68% it's practically a ghost town. Historically, if you run a fab that light, your fixed costs destroy you. You simply cannot absorb the depreciation.
Right. It's like renting a massive warehouse and only storing 3 boxes in the corner. You still pay the full rent.
Exactly. And usually that creates a massive drag on gross margins. But, and this is the part that actually impressed me, CFO Thad Trent quantified the damage. He said that 68% utilization cost them approximately 700 basis points of gross margin.
700 basis points. That's doing mental math.
That's 7%? 7 full percentage points of margin. Poof, gone. And yet, they still printed a 38.2% gross margin.
So wait, if they were running at full capacity, their margins would be, what, 45%?
Hypothetically, yes. And that is the thesis behind this whole FabRite strategy. They aren't just cutting costs, they are structurally changing the physics of their business. They've closed the inefficient legacy fabs, they've outsourced the commodity stuff, and they've kept the high-value manufacturing in-house. So even when demand falls off a cliff, like it has for the last year, they don't bleed cash. They just tread water very, very efficiently.
It's impressive, sure, but it feels a bit like holding your breath. Eventually, you need to exhale. You need actual volume.
Well, here is the other side of that coin. They aren't just waiting for volume to come back. They are actively firing customers.
Customers. That's a bold marketing strategy.
It's capital disciplined. Trent mentioned they're exiting about $300 million of annualized revenue, starting with $50 million in Q1 of 2026. They call it non-core.
Translation, low margin.
Precisely. They're looking at business that doesn't meet their return threshold and saying, we don't want it, which is why the revenue decline, that 1.3% drop we talked about, is misleading. Some of that isn't the market shrinking, it's Onsemi walking away from bad deals.
Okay, I get the logic. It boosts the margins, but Miro, you can't shrink your way to glory forever. At some point, you have to sell something that grows. If they're killing the non-core stuff and auto is flat, what is actually filling the hole?
Power, specifically the power-hungry stuff, AI data centers.
Ah, the magic buzzword. I was wondering when we'd get there.
I know. Every company adds AI to their press release now, but Hassan, the CEO, gave us a real number this time. He said they delivered more than $250 million in AI data center revenue in 2025, and he expects that to grow in the high teens sequentially in Q1.
250 million isn't pocket change. It's not NVIDIA numbers, obviously, but for a chip maker that people think of as a car chip company, that's a serious foothold.
It is, and it validates the technology. You can't run these massive GPU clusters without incredible power density, converting high voltage down to the chip level without melting the rack. That's Onsemi's playground. So while they are pruning the low-margin industrial junk on one side, they are grafting on this high-margin AI power business on the other.
So it's a rotation. They're swapping junk food for protein.
Sure, let's go with that. They're on a keto diet.
Okay, so the diet is working. Cash flow is record high, $485 million of free cash flow, which is wild for a quarter with declining sales. They bought back 100% of that cash flow in stock. So clearly management isn't scared.
No, they aren't scared. But the market still is, because everything we just described, the efficiency, the exits, the AI growth, it all relies on one thing, the bottom actually being the bottom.
Which brings us back to that industry bottom claim, because if they're wrong about the cycle turning, then 68% utilization isn't efficient. It's a crisis waiting to happen.
Exactly. So where does that leave them heading into next quarter? Are they catching a falling knife, or have they actually built a floor?
Well, if you look at the guidance, they seem pretty convinced it's a floor. They're actually guiding for year-over-year growth in Q1. That would be the first time in 3 years, Miro. 3 years of shrinking, and they're finally saying, okay, we turn the corner now.
Yeah, it's a brave call, but don't forget that revenue exit we talked about. They're proactively walking away from $50 million of business in Q1 alone. So the headline numbers are going to look messy because of that self-inflicted amputation. Underlying demand might actually be stronger than the guidance looks on paper.
It's a game of chicken, isn't it? You cut the bad revenue, you run the factories lean, and you pray the new stuff, the AI-powered chips, this new Treo platform, ramps up fast enough to fill the void.
Exactly. They are betting on a second-half recovery. If the cycle turns up, Onsemi is sitting on a coiled spring. They have the operating leverage. Their margins are already high. If volume comes back, profits could explode.
And if it doesn't? If auto rolls over, because remember, auto is half the business and it's just flat right now, then what?
Then that coiled spring snaps back in their face. Then you have 68% utilization with no growth driver, and that efficient margin story falls apart. They need cars to stay stable while industrial recovers. That's the whole ballgame.
No pressure, right? Just the global economy and car sales needing to align perfectly.
Right. Simple stuff. Just macroeconomics.
Right. Well, looking at the stock buybacks returning 100% of free cash flow, they clearly think the odds are in their favor. It's confidence, bordering on swagger.
It is, and honestly, after seeing these margins in a down cycle, I'm almost inclined to believe them. Almost.
High praise from the skeptic. All right, I think we've squeezed every drop of insight out of this one.
Yeah, I think we're done. Back to the spreadsheets.
Not for me. I'm going for a walk. But hey, that's the quarter. Onsemi is lean, mean, and waiting for the green light. Stick around for a quick goodbye.
And that is the show. But before we sign off completely, we want to take a moment to explain what you've just been listening to. And that is, the show is practically entirely produced using generative AI. The voices you're hearing right now, the research on Onsemi's margins, the script, and even the fact-checking, it was all created by a collaborative team of AI agents. We have a research analyst, a scriptwriter, a QA specialist, and us, the hosts, all working in concert.
The goal isn't just to mimic a podcast. It's to see if we can use these tools to deliver high-quality, dense, and timely financial information in a way that's actually enjoyable to listen to. We are still learning, and we are constantly tweaking the models. So we would love to hear from you. If you have questions, feedback, or just want to say hi, reach out to us at earningsunscripted@datamadness.ca or follow the project on X.
Thanks for being part of the experiment with us.
See you after the next call.